Hey folks, how you doing? Happy Sunday, May the 11th, 2025. If you can believe it. Hard to believe, but it's true. Time flies. Um, what is happening in the Bitcoin and crypto markets as we near the end of the weekly candle and near the beginning of a new one? Well, pardon me. If you've been paying attention all week, or at least last Monday, when there was a new weekly candle, I told you once again that there was still the high probability that we would see a nice move relative to the time frame, um, because we were within 0 to 4 candles of the last intersect, and that's true for this week. And so um, we saw the high probability play out, just as it did a couple weeks earlier when we were inside of that range. Well, and a different one as well, right? So once again, intersects matter. There's a reason to look for them, especially when you're looking at high time frames, but even low time frames when you're trading, right? You need to look for those intersects because there's a very high probability that they will lead to a nice move relative to the time frame. So again, like if you're on a super high time frame, something like Bitcoin can move, 6 weeks, 6 points in a week, 10 points in a week, who knows, whatever. It can move much more than that, obviously. Sometimes even 3 points in a week is a nice move relative to the time frame over the last, however many weeks. If you're like on a lower time frame, daily, it could be 1, 2, 3%, whatever it might be. Sometimes it's more, as we had last week, right? It can be, on lower time frames, intraday time frames, like 15 minutes and under. It could be 0.5%, 1%. Sometimes it's more, right? When it goes hog wild, when the honey badger is in full effect, right? These things can happen. It's crypto; it's highly volatile. But the point is, relative to the time frame, you would typically see a nice move within 0 to 4 candles of an intersect. What does that mean within 0 to 4 candles? Well, the 0 candle is the candle of the intersect, and then 1, 2, 3, 4 candles after the intersect. So it's a grand total of 5 candles to look at in terms of the high probability. Does that mean that it can't happen afterwards? No, of course it can happen afterwards. Right? You can have massive moves without there being an intersect, or a recent intersect at play, obviously. But when there is an intersect, the probabilities simply increase that there will be one. Why is that? That is because you have different volatility levels intersecting. You have the means intersecting, different means intersecting, right? When you have a power mean intersect with a reverse mean of log returns, that's telling you something very specific about the volatility. Usually that happens, not always, but usually that happens when there's extremely low volatility or extremely high volatility. And when that's the case, you're typically going to get a nice move in one direction or the other, given obviously the correlation, right? When you do that, when you look at the volatility and the correlation on candles where there are intersects, you will see usually there is a very nice confluence there. That's why that happens, right? Now, why does it happen to be that there are always these confluences? Well, they're not always, but they are most of the time. Well, the reason that they're most of the time is because the volatility tends to line up with the returns. right? The moves of the volatility tends to line up with the moves of the returns, and the standard deviations of the volatility tend to line up also with outlier on the volatility. So, for example, when the volatility returns to practically being flat, usually the returns have also returned towards the mean. Usually, when the returns have returned towards the mean and they're at or near the mean, the reverse mean of log returns often is very near the mean, or it's an extreme outlier, doing the exact opposite. After all, it's the reverse mean of log returns. So sometimes it's doing, in negative correlation, it's doing what the mean's doing, and sometimes it's doing the exact opposite of what the mean's doing. So that's why you have these confluences either saying we are positively correlated or negatively correlated. And usually it's pretty significant when those things happen. It's like significant correlation. Not always, but most of the time. And you can see that right there in the direction predictor. I'm sorry, not the predictor, in the significant correlation and the CC direction outer bands that you could put, or the colored bands that you could put on your RMLR. You can also see the direction predictor, which you can mix and match which line, which outer line, or what the inner line is, or what the outer lines are. So it's quite a significant indicator there, because you have the direction of the RMLR itself, and then you have a direction predictor if you want, and then you have a CC direction if you want, or you can put a different predictor, different. There's many different indicators that are really built into it. I typically use the CC direction and the significant correlation in addition to the direction predictor. Right, that way I can see whether or not there is correlation, and I can see whether or not it's significant. And I find that to be very useful. Not everybody does that. Some people find that to be too much information, and they just choose direction predictor and significant correlation, or direction predictor and CC direction, or whatever else they might select from that tool, which is quite powerful. But yeah, that is one of the many great functions of the RMLR, is that it shows you when you're likely to have those things. So anyway, so what is likely to happen now that it's Sunday and the markets are revving up for another week? Well, you still have today. And I know there's going to be people saying, oh, ETH is going to the moon today. My favorite YouTube Jimmy said so. And he's got $1 million trade on, or whatever. Look at his multi-million-dollar, ETH trade. It's doing so well. I've got to get my positions on ETH. Let me remind you, first of all, a lot of YouTube Jimmys, probably the vast majority of them, okay? Especially the ones that make it seem like they're great traders, actually not traders. They're YouTubers. They make their money YouTubing. They make their money when you deposit your hard-earned money onto exchanges through their exchange links. And then they get 50%, sometimes 60% of whatever you deposit, they get in trading fees, etc. So if you put $1,000 on, they're getting paid $500, $600. How do they do that? Well, exchange will pay them. And why do they do that? Because the exchange knows you're probably going to take some silly leveraged position and lose your $1,000 over a certain period of time, and they're going to get their money. And then they're going to make you, have that feeling before you get liquidated, if you don't get wrecked right away. If you don't get completely liquidated, they're gonna, you know, do what they do to get you to deposit again and again. And every time you deposit, within the first year or so, all that money that you trade on that exchange, that affiliate that brought you there gets a big, nice, fat share. Maybe they get 30%, 40%, but most of them get 50%, or the big ones get like 60%. Like, seriously, the big affiliates get most of. Why? Because, first of all, there aren't that many big crypto channels. So the exchanges are perfectly happy to pay them even the majority of the money just to get in their traders. Because remember, that affiliate deal is good for the first year. After that, it goes away. Which is why those guys don't just bring in an army of affiliates one time and stop. No, they need to keep bringing in new blood. That's the whole deal. That's how those guys make their money. Okay. If you're wondering how do they make $1 million to put on a trade? First of all, some of them on some exchanges have a very nice arrangement where the exchange will literally give them a virtual account that looks completely real, and they'll let them just use basically fake money in order to be able to show you big positions. And some of them have multiple fake accounts that look identical with the same username and everything, so they could basically open trades in opposite directions, so that no matter what, they can always show you profitable trades. How do I know this happens? I used to work for many different exchanges. That's something we did. I used to market exchanges. That's something that we did. You know, we had people whose job it was to make sure that that was doable, and we would set up accounts in different directions, and we would promote all kinds of things that you might say, hey, that's not ethical or whatever. Listen, if it's a non-regulated market, it's an unregulated market. You know what that means? There's no such thing as ethics at play here. There's money at play. You're gambling in the Wild West when you put your money on an exchange. You are gambling in the Wild West. There's no ifs, ands, or buts about it. Right? It's a shot. You're taking a shot. You're hoping you're going to make it big. If you lose, you lose. The probability is you'll lose, especially if you're not using leading information. Right? If you're using what most traders use, which is lagging information, it's extremely likely you're going to lose. Right? If you're using leading information, then you have a better shot at being profitable and consistently winning the majority of your trades. If you're not winning the vast majority of your trades, like at least one standard deviation of your trades, you're doing it wrong. And I know people in the traditional TA world think that's crazy. Like, nobody wins 68.3% of their trades as a minimum. Yeah, I know people do. It's in fact a relatively low benchmark, right? If you're good at trading, and that means that you're using leading information, right? Most likely. Now, I know 1 in 10,000 people or something are going to be quote unquote good at traditional TA. They're not really. What they really are is they're good at risk management. Okay? I was good at risk management with traditional TA, no problem. That's how I was able to remain profitable by using traditional TA. Because if I just stuck only with the traditional TA, I would not have been good. Right? And risk management is the number one thing in trading, no matter what you use. Whether it's traditional TA or leading information. Doesn't matter what you use. If you don't have good risk management, you're not going to be a good trader. What is good risk management? It means don't lose more money than you can afford to lose. Number one, don't put on more risk on the table than you can afford to lose. Right? When you hit your targets, you take the profit, right? You follow the 3 rules of trading. Number 1 is take profits early and often. Number 2 is limit your loss. And number 3 is don't be emotionally attached to your trades. But risk management is knowing how to size your position, right? And that's very important. Sizing your position size is extremely important because that determines usually also where you will be in the queue, in the order queue. Get your orders filled. The bigger your position size, the the faster your orders get filled. If you can't afford a huge position size, if it's too risky, then you shouldn't put one on. Right? Even without leverage, you still, like, just because you have a bunch of trading capital doesn't mean you put all of it on the risk table. Right? You need to put on only the amount that you can actually afford to lose.